Individual stock and index fund stock. Individual stock and index fund stock. Individual stocks are shares of ownership in a specific company, while index funds are a type of mutual fund that tracks a particular market index, such as the S&P 500. When you invest in individual stocks, you are betting on the success of a particular company. The value of your investment will rise or fall depending on how well the company performs. This can lead to greater returns if the company performs well, but also greater risk if the company performs poorly. On the other hand, when you invest in an index fund, you are buying a diversified portfolio of stocks that tracks a specific market index. This provides exposure to a broad range of companies and helps spread out risk. The value of your investment will rise or fall along with the overall performance of the market index the fund tracks. In general, investing in individual stocks can be riskier but also potentially more rewarding, while investing in index funds can be more stable and less risky. It's important to consider your own risk tolerance, investment goals, and level of knowledge and experience when deciding which approach to take. What's the difference between individual stock and index fund stock? Individual stocks and index fund stocks differ in several ways. Ownership. When you invest in individual stocks, you own shares in a particular company, and your returns depend entirely on that company's performance. When you invest in an index fund, you own a small piece of a larger portfolio of stocks that are chosen to mimic the performance of a particular market index, like the S&P 500. Risk. Individual stocks tend to be riskier than index funds because the value of your investment is tied to the performance of one company. If the company does poorly, the stock price will drop, and you could lose a significant portion of your investment. In contrast, index funds spread out risk by investing in many companies, reducing the impact of any single company's performance on the overall portfolio. Diversification. Investing in individual stocks requires careful research and selection to build a well-diversified portfolio. In contrast, index funds are already diversified, as they hold a large number of stocks across many sectors and industries. Cost. Investing in individual stocks can be expensive, as you may need to pay a brokerage fee for each trade. In contrast, index funds generally have lower costs, as they don't require the same level of research and management. Returns. The potential returns from individual stocks can be higher than index funds, but they can also be more volatile. Index funds provide more stable returns over time, but with lower potential gains. Overall, individual stocks are suitable for investors who are willing to take on more risk and are willing to put in the time and effort required to research and manage their portfolio. Index funds are a good option for investors who want a low-cost, diversified, and low-risk investment that will provide steady returns over time. Can you give me growth forecast between individual stock and index fund stock? However, historical data suggests that over the long term, stock index funds tend to outperform individual stocks due to their diversification and lower fees. This is because index funds provide exposure to a broader range of companies and industries, reducing the impact of any one company's poor performance on the overall portfolio. Individual stocks, on the other hand, can have higher growth potential but also come with greater risk. The performance of an individual stock is tied to the performance of one specific company, and if that company underperforms, the value of the stock may decrease significantly. Ultimately, the choice between investing in individual stocks or index funds depends on individual investment goals, risk tolerance, and personal preferences. It's important to conduct thorough research and seek the advice of a financial advisor before making any investment decisions. Review on individual stock and index fund stock performance. A study by Vanguard in 2019 found that over a 20-year period, 70% of actively managed funds underperformed their benchmark index, while only 16% of index funds underperformed their benchmark index. According to a Morningstar report, from 2004 to 2014, the average annual return of actively managed funds was 4.6%, while the average annual return of index funds was 6.1%. A study by Standard & Poor's in 2018 found that over the past 15 years, the S&P 500 index, which is commonly used as a benchmark for U.S. stock market performance, outperformed 83.4% of actively managed large-cap funds. In terms of risk, a study by Bankrate found that in the 10-year period ending in 2019, the S&P 500 index had a standard deviation of 13.1%, while the average stock mutual fund had a standard deviation of 14.2%. These statistics suggest that index funds tend to outperform individual stocks and actively managed funds over the long term, while also being less risky and less expensive. However, It's important to note that individual stock performance can vary widely depending on the specific company and industry, and past performance is not always indicative of future results. Review on individual stock and index fund stock performance. A study by Fidelity in 2021 found that over a 30-year period, the average annualized return of the S&P 500 index was 9.5%, while the average annualized return of actively managed funds was 7.7%. A report by S&P Dow Jones Indices in 2021 found that over a 20-year period, 94% of large-cap fund managers, 94% of mid-cap fund managers, and 97% of small-cap fund managers underperformed their respective benchmark indexes. A study by Morningstar in 2021 found that over a 10-year period, 64% of active U.S. stock funds underperformed the S&P 500 index. A report by Vanguard in 2020 found that over a 20-year period, the average expense ratio of an actively managed fund was 0.64%, while the average expense ratio of an index fund was 0.09%. These statistics suggest that index funds continue to outperform actively managed funds and individual stocks over the long term, while also being more cost-effective. However, it's important to note that past performance is not always indicative of future results, and investors should carefully consider their own risk tolerance and investment goals before making any investment decisions. Individual stock and index fund stock performance and dividend payout. In terms of dividend payouts, individual stocks and index fund stocks can vary widely based on the specific company or index being considered. Here are some general observations about dividend payouts for individual stocks and index fund stocks. Individual stocks. Some individual stocks pay regular dividends to their shareholders, while others do not pay any dividends at all. The decision to pay dividends is typically made by the company's management and is influenced by a variety of factors, including the company's profitability, growth prospects, and cash flow needs. Companies that pay dividends tend to be more established and mature, while growth-oriented companies often reinvest their profits back into the business instead of paying dividends. Index fund stocks. Index funds are designed to track the performance of a particular market index, such as the S&P 500 or the Dow Jones Industrial Average. The dividend payouts of an index fund will therefore depend on the dividend policies of the underlying companies in the index. For example, If the S&P 500 index has a dividend yield of 2%, then an S&P 500 index fund would be expected to have a similar dividend yield. In general, dividend payouts tend to be more stable and predictable for index funds compared to individual stocks. This is because index funds typically hold a diversified portfolio of stocks, which can help to smooth out fluctuations in dividend payouts from individual companies. However, some individual stocks may offer higher dividend yields than index funds, which can be attractive to income-seeking investors. It's important to remember that dividend payouts are not guaranteed and can be subject to fluctuations based on market conditions and other factors. Growth, performance, return, loss for both individual stocks and index fund stock for the past 35 years. It's essential to note that past performance is not a guarantee of future results, and investing always carries the risk of financial loss. That being said, there are several ways to analyze the growth, performance, return, and loss of individual stocks and index fund stocks over time. This information can be obtained from financial reports, websites, and other sources that provide historical market data. Investors can also consult with financial advisors or use online tools to track and compare the performance of different stocks and indices. Financial reports, websites, and other sources that provide historical market data for stock. Which website can I use? There are many websites that provide historical market data for individual stocks and index funds. Here are a few popular options. Yahoo Finance. This website offers real-time stock quotes, historical data, and charts for individual stocks and index funds. Users can also track their portfolios and create custom watch lists. Google Finance. Similar to Yahoo Finance, Google Finance provides market data, news, and charts for individual stocks and index funds. It also allows users to create personalized portfolios and watch lists. Morningstar. This website provides investment research, data, and analysis for individual stocks, index funds, and other financial products. Morningstar offers a range of tools and resources for investors, including stock and fund screeners and portfolio analysis. Investing.com. This website provides real-time data, news, and analysis for individual stocks and index funds. It also offers customizable charts and technical analysis tools for investors. Bloomberg. This website provides comprehensive financial news, data, and analysis for individual stocks and index funds. Bloomberg also offers a range of financial tools and software for professional investors. Please note that some of these websites may require a subscription or registration to access certain features or data. Additionally, it's important to remember that historical market data is not a guarantee of future performance, and investing always carries risk.